purchase expenses and minus closing stock. So cost of goods sold will be determined through this formula. Operating expenses is ultimately a consideration of administrative expenses plus selling and distribution expenses, but financial expenses cannot be considered for the calculation of operating expenses. So any non-financial expenditures are there which would be added here. So but instead of financial expenses, the total of administrative and selling and distribution expenses would be considered under this particular category. And the merge of the cost of goods sold and operating expenses, the total amount would be divided with the sales. Let's find out the operating ratio. Ratio's formula is operating profit divided by sales into 100. How you can determine operating profit? Operating profit you can determine through the sales minus cost of goods sold plus operating expenses. In previous formula you already knows that how to find out the operating expense ratio. So in that the cost of goods sold is already determined, operating expense which carried administrative expenses and selling and distribution expenses as well as the non-financial expenses. The total of this would be deducted from the sales. You determine operating profit, and that operating profit is going to compare with the sales. Ultimately it shows the operating efficiency of the business, how much amount of operating profit has been derived against the comparison of sales. The next is net profit ratio. The net profit ratio is the comparisons of a net profit divided by sales. So it shows the how much amount of net profitability against the sales. The net profit is determined after all the type of provisions. Provision for taxation is also included in that, right? So all the third party expenditures as well as the profitability of the concerned business, the third party expenditures has been deducted, manufacturing expenses has already deducted because of the gross profit ratio has been done. So the comparisons of the what amount of net profitability is available against the sales, that would be comes from the net profit. In context of investments, there are three different ratios. One is return on capital employed, then the return on shareholders fund, and then the return on equity shareholders fund. But for this all the three ratio, you need to identify your profitability. So your profitability is very much concerned in the case of all these three ratios. For that, the different profits would be considered under these all the three ratios, as well as different capital is also considered, but the capital we would be discuss just after some time. Right now we just find out the what amount of profitability and which profitability would be considered under all these three categories. Start with the sales. Here the sales is written less cost of goods sold deducted from it, that is your gross profit. From the gross profit less all administrative expenses, that means operating expenses, selling and distribution expenses, and non-financial expenses. So all these expenditures are deducted from it, that is your EBIT. From EBIT less financial expenses deducted, that financial expenses like interest, and that is your EBT. From EBT, provision for tax or tax deducted, that is your PAT, profit after tax, less preference dividend deducted from it, and that is your divisible profit. So here there are three important part is required. One is EBIT, second is profit after tax, and the third is divisible profit. So that means these three profits are very much important in all these three formulas. We are find out the profitability in context of investments. Let's begin with the first, ROC. ROC, it means the return on capital employed. Return on capital employed means the total amount of investments made by, whether it is invested by the owners of a company or third party, the considered as a borrowed funds. The total amount of investments compared against the EBIT. It means what amount of earning before tax is there against your total amount of investments. That return represents the amount of profitability against your total amount of investments. Here, now see the first formula, that is ROC, is EBIT, earning before interest and tax, divided by return on capital employed into 100. So EBIT, how you determine, that is already comes from this formula. But what is ROC formula? That is equity capital plus preference capital plus long-term borrowed funds, that means debentures and bank loans and other things, reserves and surplus, minus fictitious assets. Fictitious assets would be deducted from all the three formulas. Why? Because of fictitious assets is not actually an assets. It is an expenses which are not written off and write off in a 1 year. It may be write off in a number of years, and that is why we are showing as a fictitious assets, but it is not an asset. That's why it would be deducted always whenever you find out your capital structure and capital employed. Not even a capital employed, but even shareholders fund and equity shareholders fund also, fictitious assets are deducted. So return on capital employed is actually find out. So this is a capital employed. Capital employed find out equity share, preference shares, long-term funds, reserves and surplus minus fictitious assets, and answer would be coming in percentage. This percentage represents the amount of return on your total investments, whether it is in your investments, owner's investments, or an investments through the borrowed funds. Now coming to the next is return on shareholders fund. The formula is profit after tax divided by shareholders fund into 100. Again, this is also find out in percentage. Profit after tax can be find out from this way. How you can determine your profit after tax. So here the profit after tax would be considered here. If you are going to compare these two, the two things are actually deducted from the EBIT. One is your financial expenses, that is interest, and the other is provision for taxation. The taxation provision has been also deducted when you find out the profit after tax. Here, when you find out the shareholders fund formula is equity capital plus preference capital plus reserves and surplus minus fictitious assets. Now see, compare these two formulas. Here we are actually consider a long-term borrowing funds in case of ROC, return on capital employed, that means the total amount of funds. But in case of a shareholders fund, we consider only ownership fund. And that's why when you take it ownership funds, interest has been deducted from your profitability. So the comparison of two this, here in earning before interest and tax, interest was there. Because of the capital employed, that long-term borrowed funds are also included. In case of profit after tax, interest is deducted because of the borrowed funds are not considered under the fund. So that's why when we find out the shareholders fund, that equity, preference, reserves and surplus and minus fictitious assets, that is considered and compared with the profit after tax. And again the answer comes in the percentage, which represent the amount of return has been determined of your total amount of shareholders fund. And coming to the next and last formula, that is return on equity shareholders fund. The formula is very simple: PAT minus preference dividend divided by equity shareholders fund into 100. You can write it instead of this divisible profit also, which is already found out here. Ultimately divisible profit is also found out through the profit after tax minus preference dividend. Or you can write both the things here, profit after tax minus preference dividend divided by equity shareholders fund. Now see this formula. Equity shareholders fund is equity capital plus reserves and surplus and then minus fictitious assets. In that sense, comparison with these two, here the preferential capital was there in shareholders fund, but at the time of equity shareholders fund, preferential capital is removed, and that is why the preference dividend is also deducted when you find out return on equity shareholders fund. So this case would be beneficial of the amount of return of equity shareholders fund, how much amount of return has been derived for the return on equity shareholders fund. So in that case, all the three ratios which are find out for context of investments. Moving to the next segment, that is liquidity ratio. Liquidity ratio is all about to determine liquidity positions of the company. That means it shows the working capital management and working capital strength in the company. For that, we have three ratios: current ratios, quick ratio, and acid test ratio. All these three ratios would be helpful to find out the liquidity strength of the company. Let's begin with the first, current ratio. Liquid positions of the company for short period or short durations. For that, we need to compare the current assets divided by current liabilities. Here I want to mention all these three ratios would be determined and identified in the proportion. So the proportion was actually determined on the basis of base. So the base is always considered 1, and against the comparison of 1, what would be the answer? It comes here. So we will find out the amount of the possibility of strength of liquidity of the company. For that, the current ratio shows the possibility of how much amount of the current assets is available to meet the current liabilities paid at the time of maturity easily. So for that, the current assets would be considered debtors, cash balance, bank balance, stock, bills receivable, or any outstanding incomes. This would be considered under the heading of current assets. And the current liabilities is considered creditors, bills payable, bank overdraft, any outstanding liabilities. So these are, and here one more thing you can consider, marketable securities, like a short-term investment. Short-term investments is also considered under the heading of current assets. So this is a comparison of a current ratio. So how much amount of current asset strength is there to meet all the current liabilities at the time of a maturity period? This ratio represents the working capital strength of the company. Now moving to the next ratio is quick ratio. It is a comparison of quick assets divided by quick liabilities. Ultimately, this ratio is actually a represents of this current ratio only. Here, when you find out the quick ratio, we need to identify how much quick assets and quick liabilities you are carried in the business. That means the quick assets is equal to current assets minus stock. That means if you remove a stock from the current assets, it's considered your quick assets. And quick liabilities is current liability minus bank overdraft. So if the bank overdraft has been removed from this, it's considered a quick liabilities. So the comparison of this quick assets and quick liabilities, it shows your quick ratio. Quick ratio is actually shows a position of the how much amount of cash and liquidity is available to meet immediate liabilities payment. Immediate maybe within a 5 days, within a 10 days you want to pay. And if there would be any quick assets which you have, we can dispose of and get it the cash back and meet with the payment of liability. So this is a quick ratio. And the acid test ratio is marketable securities. That means cash, bank, and investments, short-term investments, which are easily converted, immediately converted into cash and bank, would be divided by liquid liabilities. So if any circumstances raise in the company that immediate liabilities to be paid within 24 hours or in an immediate situation, maybe sometimes you need to purchase raw materials or maybe labor to be paid immediately, marketable securities and such type of assets in need, and that is showing a comparisons of whether the company has in a situation to meet their acid test. So this ratio would be helpful to understand their acid test position. Here the standard of the current ratio is 2:1. It means if the company have a double current assets and the current liability, that is the standard part. In case of a quick ratio, if they have equal current assets and liabilities, quick assets and quick liabilities, that means 1:1, it is a standard ratio. This is standard not as defined, but the standards has been understood on the basis of certain parameters, which may not be same in all the cases. This is what all about a liquidity ratio. Turnover ratio. Turnover ratio is ultimately showing an operational efficiency and the efficiency of the company. That means if there would be any leaking, so far as concern of operational efficiency, this ratio would be helpful to improvisations and find out the deficit and find out the certain amount of change in the different criteria and find out the efficiency level. So here we start with the inventory turnover ratio, that is the stock turnover ratio. Stock turnover ratio is represents of the how many times the stock has been turnover in the business in a year, and it would be compared of the cost of goods sold divided by average stock. It means the average stock, it means opening and closing stock, average compared with the total amount of manufacturing cost. So the how much amount of stock has been, fine, cost of goods sold, it means the manufacturing cost per unit or the manufacturing cost of the total number of units. On the basis of that, the how much total amount of cost incurred and rotate in the business in a year would be determined from the inventory turnover ratio. It shows an efficiency of the company, that means the how many times has been refined or functioned in the business would be identified from the stock turnover ratio. It could be helpful to more and more efficient business in coming years. Next is debtor turnover ratio. Instead of one, I will take it both. Debtors turnover ratio and creditors turnover ratio, both are actually related to a working capital management. So it would be helpful how the working capital management can be more and more improvisations. How? Let's see. The debtors turnover ratios formula is debtors plus bills receivable divided by average credit sales per day. So average credit sales per day can be determined through total credit sales divided by 360 or 365 days. If it is mentioned in the question, you can take it the number of days as per the mention in the question. But if it is not mentioned, you can take it 365 days. It will be divided to the total credit sales in a year. And that total credit sales in a year divided by 365 would be compared with the debtors and bills receivable. So that answer is find out in number of days. So this answer would be actually helpful, that the how many days credit period has been offered by a company to their debtors. In case of creditors turnover ratio, that is creditors plus bills payable divided by average credit purchase per day. It means the average credit purchase, the total credit purchase divided by 360 or 365 days and determined also in the number of days, shows that the how much credit period has been offered by a creditors to the company. When you purchase credit, and that time how much credit period you are getting from your creditors, and when you say how much credit period is offered to your debtors, this is actually try to balanced. If your credit period given to the debtors is more than the credit period offered by your creditors to you, that means you need more amount of liquidity in the business. So ultimately it affects your working capital. So this is related to a working capital management. Now here the fixed asset turnover ratio and total assets turnover ratio, which shows the comparisons of the amount of fixed assets with the sales and the total assets with the sales. It means net sales divided by fixed assets and net sales divided by total assets. So in case of the amount of the total assets and fixed assets have contributions in the total amount of net sales, it shows that the how much sales has been incurred in case of your assets comparisons, which shows the picture of the improvisation, contributions of your assets, whether it is a fixed assets or a total assets in case of a realization of sales. Moving to the last part, that is ownership ratio. Ownership ratio is actually find out for the informations compared between the amount of ownership fund with the other part of funds, maybe a debt funds, maybe a other type of assets, maybe a fixed fund with the borrowing funds, and the amount of funds with the different type of assets. Here let's start with the debt equity ratio, which is a very important ratio in ownership ratio. Debt equity ratio is a comparison of long-term funds with the shareholders funds, long-term liabilities. divided by shareholders fund. Debt equity is actually determined to find out the long-term solvency positions. Why the long-term solvency is required? Because of the company willing to know that whether the company have enough amount of ownership fund in the business to meet regularly or maybe at the time of maturity to repay the long-term liabilities. In the long-term liabilities, it could be debentures and the bank loan. This or maybe financial institution loan also. So any amount of debentures, bank loan or financial institution loan which are more than a number of years, maybe more than 1 year, that is considered as a long-term liability. Comparing to the shareholders fund, shareholders fund formula is very simple: equity capital plus preference capital, reserves and surplus minus fictitious assets. So this shareholders fund is going to compare with the long-term liabilities and identify that the proportion of this ratio is, if it shows the positive ratio or strength to be shown from this ratio, it shows that the amount enough available in the business to meet all the long-term liability at the time of their maturity. Coming to the next is shareholders fund equity ratio. It is a comparison of shareholders fund with the total assets. Shareholders fund with the total assets. It means how much amount of shareholders fund is available and which is a part of total assets. It shows the information that how much shareholders fund is carried in the firm, that equity, preference, reserves and surplus are carried by the owners and which are invested in the total assets. It means that if it is more than 60% or 65%, it shows that the good amount of shareholders fund invested in the total assets. Ultimately, it represents the strength of the company, which shows the good amount of shareholders fund invested in the total assets. Capital gearing ratio is the fixed interest or dividend securities divided by equity shareholders fund. Ultimately, this is a comparison of the fixed burden securities divided by equity shareholders fund. How much fixed burden securities carried in the firm against your equity shareholders fund. That means the interest to be paid to the debenture holders and the preference dividend paid to the preference shareholders against your equity shareholders fund in the business. This comparison shows that the amount of equity shareholders burden carried against the fixed interest securities and fixed dividend securities. The next is long-term funds to fixed assets ratio. That long-term funds divided by fixed assets. It is a simple, it's almost a comparison like this only, but here this comparison is different because of in this fund we are considering only shareholders fund against the total asset. That means how much shareholders fund has been invested in total assets. Here how much total long-term funds, that means there is no specification whether it is an equity fund or a debt fund. Whatever the long-term fund has been invested in the firm, that is to be invested in fixed assets or in current assets. So it represents that the amount of fund invested for a long term, it is invested either in a fixed assets or in a other different type of assets, that is represented through this ratio. And this is called ownership ratio and identify the ownership positions of the business. So this is what all about ratio analysis. We discussed the various portions of the ratio analysis, beginning with the introduction, definition, limitations and everything, and at the last we were discussing the classification of ratio, specifically a traditional classification and the functional classification, and on the basis of both the classifications we discussed the various formulas also, how this formula would be using to analyze the statistical informations and try to convert the higher denominations into the lower denominations to understand the informations would be more suitable for a future part of a decision making. So this is all about ratio analysis. It is used for managers in the future and for taking